Greetings, everyone. Today, we are going to be learning about how to take advantage of net unrealized appreciation treatment on your appreciated ExxonMobil stock held within the savings plan at Voya. My name is Kyle McClain, and I'm a partner and senior wealth manager with Rame & Gorell Wealth Management. Net unrealized appreciation, or NUA, can be a complex topic. So if you or someone you know could benefit from this information or the other services that our firm offers, please reach out to our team for a complimentary consultation where we will take a look at your financial situation to determine opportunities for optimization from an employer benefits, executive compensation, investment, tax, estate, and retirement planning perspective. Net unrealized appreciation is one of the most lucrative tax strategies available within the Internal Revenue Code. NUA allows ExxonMobil employees to decrease their tax bill on appreciated shares of company stock owned within the savings plan. In order to fully understand the benefits of this strategy, it's important to know what the distribution options are for your ExxonMobil stock within the savings plan. The first option is to roll the stock over from the savings plan to an IRA and continue deferring taxes. This eliminates the availability of the NUA strategy, and normal distribution rules will apply for distributions taken from a Roth or a traditional IRA account. The second option is to take a distribution directly from the savings plan and pay ordinary income taxes on the full amount. This also disqualifies an individual from taking advantage of NUA treatment. The third option is to utilize net unrealized appreciation treatment on the ExxonMobil stock and move it from the savings plan to a brokerage account, allowing the employee to reap the more favorable capital gains tax treatment on that appreciation or growth that has occurred. Let's take a look at how this actually works. First, an employee must be eligible for a distribution from their qualified plan, generally at retirement or age 59 and a half. This employee will take a lump sum distribution from the plan, distributing all assets from the plan during one tax year. The portion of the plan that is made up of mutual funds and other investments can be rolled into an IRA for further tax deferral. The highly appreciated ExxonMobil stock would then be transferred to a brokerage account. At this time, the NUA rule is applied, and the employee will incur an ordinary income tax liability only on the cost basis or price paid for the ExxonMobil stock. The appreciation of the stock above its cost basis while in the 401k is not taxed at the higher ordinary income tax rate, but at the lower long-term capital gains tax rate, typically 15%, but in some instances as low as 0%. This could mean potential savings of up to or over 20%. To better understand the benefits of this strategy, let's put some numbers to it. We will assume that the value of Exxon stock within the savings plan is $500,000. The cost basis or price paid for the stock is $75,000. If one rolled the entire amount to an IRA, they will owe nothing in taxes presently. However, when these dollars are eventually distributed, the employee would pay $120,000 in taxes, assuming a 24% marginal federal income tax rate. If instead, this employee chose to utilize net unrealized appreciation treatment on the shares, they would pay ordinary income tax on the cost basis at the time of distribution. This would total $18,000 in tax liability today. However, assuming a 15% long-term capital gains rate, the taxes paid on the net unrealized appreciation would be 15% of the gain, or $63,750. This brings the total tax liability to $81,750. In this example, the employee saved over $38,000 in tax liability by utilizing NUA treatment. However, If the employee were to receive a 0% long-term capital gains tax rate through the advanced planning that our team of CPAs provide, this savings could jump to over $100,000. While this strategy can seem like an absolute win from a tax perspective, there are a few important factors to keep in mind. NUA only makes sense when an employee has low cost basis in their ExxonMobil shares. It is not uncommon for Exxon employees to have these low basis shares due to a variety of stock splits over the years, as well as the turmoil in the stock that happened during COVID in 2020. Stock shares must transfer in kind to a taxable account. This means that the shares must not sell, but must move from the savings plan into the new taxable brokerage account. It's also important to take advantage of the NUA rule prior to a rollover. Once the retirement assets have been rolled over into an IRA, it is too late to take advantage of these potential savings. Thanks again for spending some time with us today to learn about net unrealized appreciation treatment within the ExxonMobil Savings Plan. At Raymond Gorell Wealth Management, we have over $1 billion in assets under management. And as a firm, we strive to serve as an effective one-stop shop for comprehensive retirement planning. Our team of CFP and CPA professionals specializes in helping our clients take advantage of advanced financial strategies to materially enhance their ability to enjoy their life, both before and after retirement. We invite you to schedule a complimentary consultation with our team by giving us a call, sending us an email, or visiting our website today.